Hello Pierre, a special edition of our regular meetings, interviews together. You're making the news, merging with Rothschild. Can you present this merger?
Sure. Hello Thomas. This merger is about getting HDF to the next level. We had discussed in our last meeting the need we started to feel to reach critical mass, go beyond critical mass. And this is really what this deal is bringing us. Let me describe it maybe first.
Yeah.
So very simply, HDF will continue as a legal entity, but will be redenominated into Rothschild HDF Investment Solutions.
Which branch of Rothschild? It's David the Rothschild?
Yes. It's the bank, Rothschild and Company, which has an asset management arm. They manage about 20 billion. And the interesting part is 17 billion out of the 20 is direct equity, credit, etc. Products. But they also have a 3 billion asset management in a multi-managers program, both long-only and alternative. And this is the section of their business which joins force with HDF to form this new entity. The deal is not done yet. Officially, the closing will only be early July, we hope. I mean, it goes through the AMF, approval process. But we expect that to be closed very soon. And we've already been working, obviously, with the teams there to start thinking about how to organize things once we are together.
And at the end, there will be a cross-shareholding?
Yes. Essentially, it will be an entity which the Dufretet family will continue to have a 33% interest in, the rest being in between the key members and Rothschild and Company.
Is it a defensive move?
You could call it defensive. I would call it rational and reasonable. Certainly, HDF could have tried and continue as a independent actor, but as we had discussed, there was the risk that the current context, which especially in France, and 80% of HDF clients are French and French institutions, and most of them being under Solvency II regulation framework. And as you know, Solvency II is coming very soon, and there are very adverse consequences for those not having developed internal models for alternative within this framework. So there was a risk that HDF would have continued to face headwinds in terms of interest from our natural clients there. Whereas by joining forces with Rothschild, we give ourselves much stronger chances to attract interest for two main reasons. One, because we can invest a lot faster in the ways that will be necessary in a Solvency II context to bring up the products that will optimize, cash management, risk management, namely managed account formats, private managed accounts eventually. And second, also internationally. HDF has amazing track record, but who has heard of HDF?
This is why we switched to English.
Absolutely, and as you can see, I just had a crash course last night, and
You're fluent. Very good. You give us a number of your teacher. No, joke apart. Will it change anything for your customers, the French base?
Yes, we do see that obviously this deal brings a lot of value in terms of a number of elements. As I mentioned, it's going to be called investment solution, Rothschild HDF Investment Solutions. We will have the means to invest in the technologies that will be required to bring up this more efficient product in a Solvency II context, i.e. transparization is one of the elements which needs a lot of technology investment. It will be not so much of a change in terms of portfolio management responsibility. We don't want to create any perception by investors that they might face some brutal changes. Absolutely not.
The same also kind of philosophy.
It's first of all the same kind of approach that Rothschild has had, especially in the alternative side of the business, which is what we have, for the majority of our product. But what it will change is also the fact that Rothschild has a much stronger experience and credibility, therefore, in managing dedicated products. Actually, a majority of their assets are in long-only, not alternative. It's about 3/4 are in long-only products. We also have some long-only, but for clients, we've always been perceived as very clearly alternative specialists, not so much long-only. Here we're gaining that credibility. And also we're gaining credibility in that they have much more dedicated product than flagship products. So it's a very nice fit from this merge, which we think both clients, I mean on their side and our side, of course we have many clients that are common. You know, we went to visit a lot of them together. And apart from the name, which sometimes, still doesn't really, it's a bit of a mouthful.
Yes. Too long.
They were absolutely delighted with every aspect of the transaction.
In terms of management, what will evolve? You're not the boss anymore.
I am a smaller fish in what I hope will be a much bigger pond. Yes, I'm becoming deputy CEO, and it will be Jean-Louis Laurence, who is the CEO of Rothschild & Company Gestion, which is the asset management and private bank arm of Rothschild & Company, who will be the president of this new entity, and Denis Faller will be the CEO.
Pierre, is there any other fields where this merger will make a change?
It will certainly increase our ability to push forward our agenda in terms of being a signatory of the PRIs. Rothschild & Company Gestion are also a signatory to the principle of responsible investment. As we had discussed previously here, we identified that there are a number of hedge funds, it's not the majority, but a number of hedge funds that are very keen on integrating environmental, social, or governance factors in their investment process.
You're a true believer in this.
I'm absolutely a true believer. I'm convinced that, especially with the crisis, there will be more and more focus, and public opinion, governments will end up creating a lot more of a regulatory environment in which companies that are good at anticipating the changes and adapting to the changes will do better. So not only will it be a matter of companies having, for instance, a poor policy in terms of environmental risk management be sanctioned by the market when an accident happens, but quite importantly, it's actually well before the accident happens. If this company is visibly under-investing where it should be investing, that it will be sanctioned. So what we're talking about is the price discovery mechanism to be more and more influenced by those long-term externalities, long-term factors. So managers who are able to work in this environment and make good usage of the KPIs that are material to companies will probably do better.
Okay, let's talk about the markets now, because it's very rich period.
Intense moment as well.
Yeah. Yes. I read Josh Soros estimated that the Eurozone has 3 months to find a solution, or it will end up in a bad way. Do you share this opinion?
I think it's pretty much consensus now that we're reaching a very critical juncture where
the climax.
Climax
like
where yes, you'll have to decide whether to go. The Economist had that at its cover page a few weeks ago. Breakup or integration, and
merging like you did at your level.
There was no breakup option, but yes, no, absolutely. I think the key here is to determine whether or not it's a relatively well-controlled game still by the Germans, because clearly they have the means to decide in which direction it will go. Or if you think that they are powerless, or that elements of domestic politics continue to dominate, in which case the policy risk is enormous. And maybe Jacques Attali, who was kind enough to accept an invitation to come and talk to our investors last week, would not be upset me quoting him. But he said, Europe already committed suicide 4 times. Why not a 5th time?
Yeah. So you still believe that the worst case scenario could happen? Which one do you favor, breakup or merger?
No, I continue to favor a scenario where, again, the Germans actually are playing quite a smart game. They, the Greeks have good cards in their hand. They are very frightening with their, threat to create a contagion risk in Europe and to try to obtain as much as possible. Stay in the euro, of course, because the last thing you want is to decide by yourself to leave. You want to be like this employee who doesn't want to resign but waits to get fired. And of course, it would be extremely dangerous for Europe to fire any of its members because then it creates the contagion risk.
Of course.
So the Greeks are playing their cards quite well, but I think the Germans are as well. And you will notice one of the things we've always said, you need a lower euro for the European project to have better chances of surviving.
And it is happening.
And it is happening. Because the nice byproduct of this crisis is that finally you have some of the sovereign fund getting out of their euros and piling up in dollars or etc., which will leave a better chance for those southern countries to survive the austerity side of the packages. It will be a two-sided packages, growth and austerity, we know that. But there's a necessary element of austerity for the Germans to back the whole scheme.
Is there a bubble in the bond markets?
Absolutely. That is the ultimate bubble. What I would define a bubble is when you have people buying something not because of they see fundamental long-term value in it, but
because they're afraid.
Because they're afraid, and because they're afraid that if they do anything else, they will suffer a mark-to-market risk, which might be dangerous to their own career. And that's what you see, buying bonds in Germany, in US, even maybe in, you could say in the UK, or even in France. When you know that inflation is already well above 2%, when you know that most likely inflation will be the way, or one of the component to a solution 3 to 4, 5 years down the road to make the real value of debt less and more affordable. So therefore those bonds absolutely have no value.
So one last question, in this environment, which asset do you prefer?
Not much change from our discussion in January. We were cautious about markets, saying they could very well end the year not so much stronger. Now they're probably below the level where we think it's an equilibrium value.
So
if I'm right about Germany finally giving up, certainly not the euro bonds, they won't give up that, but they will accept some form of project bonds, some form of maybe the Commission reserve funds being mobilized, European investment banks being called to the party, and most importantly, some form of European FDIC. If indeed you see those steps being taken, certainly the equity market has some value, but be aware of the fact that it will continue to be a bumpy road. We're not out of the woods yet, but credit, if you consider the world probably exaggerates the tail risk, credit is where you have most value.
So this is your favorite asset?
It would be continue to be my favorite asset, yes.
Thank you, Pierre, and
Thank you very much, Thomas.
Good luck for your new adventure.
Thank you very much.